The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Afternoon to my friends in Europe. We are about to get this live trade event started. Before we do, I want to make sure that everybody can see my screen. I'm pretty sure you can. And if you can hear me okay, just type something in the questions box. All right, perfect, excellent. All right. So today's live call event, I try and change it up a little bit every now and again. So what I'm going to do is I'm going to go ahead and take this trade that's on the board. I'm going to show you what it is here in a minute. I'm going to go ahead and put it in place, and and then hopefully it'll be filled because sometimes these aren't filled exactly. When you place it, the mid is at 326. So I'm going to place it at 325, and I've already got my margin hedge order in place. And so I'll go ahead and just throw that in there, and we'll have that working as we are talking about this particular trade. All right, so let's take a look at what I just placed. It's a very simple trade. It's a 1-2-1 trade, and that means it's equal. Obviously, there's no it's not weighted. I talked about weighted trades in the last couple of live sessions, and I've talked about weighted trades in some of the other sessions. All right, so this is the trade that I placed, and the reason that I placed this trade is because I am expecting, or maybe a little bit biased towards, a move to the downside after this consistent move up over the last week and a half, a little more than that. Um, we have a pretty good shot at seeing some sort of retracement or reprieve from this. However, that's not why I took this trade in particular. I took this trade in particular because the probabilities of success are very, very high of something, and the risk is super, super low. All right, now before I get into the details of this trade and the mechanics of it and what it is and why it looks this way, et cetera, et cetera. One thing that I have consistently seen, not from everyone, but especially from those who are new to my way of approaching options, which is through the PPD sessions, is the fact that there are that finding a trade can be difficult, and it's actually not difficult. It's just that there are sometimes so many different combinations that you can use, so many different ways of taking the trade, so many different projection graphs that can be displayed, doing different things and whatnot. So what I'm going to do today with this, starting with this first trade, and then we'll come in, we'll take another trade a little bit later as we get through this first trade, is I want to emphasize that you don't have to look through 1,000 risk graphs to find the trade that you really want to take during the week, or a couple of trades during the week. You don't have to. Obviously, for those of us who are sometimes obsessed with this kind of stuff, we pour through 1,000 risk graphs because we like doing it. I like doing it. I like seeing what's available. I like seeing how everything interacts with one another. I like seeing the different prices during the different times of the week of the same spread. So I track those. I've got so many trades on right now, it's ridiculous and in option insanity, because this week has been a little bit different than other weeks. There's been some reports that have kind of kept the volatility a little bit higher, even though the market's um, skating on all-time highs right now. And so there have just been numerous opportunities throughout the week. And so I get it. It can be somewhat stifling. It can be paralyzing to have that many choices and not know which is the best one or not know which is the right one. And so I've doing a couple of things to address that for those who are in that position and you're like, I'm looking at these risk graphs and I just don't know and this and that and whatever. So first of all, there's one thing that you can do is you can pick, and I mentioned this previously, but you can pick one or two of the trades, one or two of the setups that you have seen in one or two of the weekly reports for Option Insanity, and you can just follow those, just just those, and maybe some slight variations. You can play with some slight variations. We're going to do that. I'm going to show you how to just take one setup and just play with it a little bit to get to know what these changes or how these changes affect the overall risk reward projections on these trades. And so um, I'm gonna give you one here, and I'm gonna explain it, and you can play with this. And I've taken several variations of what I'm going to show you of this one single trade, and it is kind of like a pattern, if you will. This is a pattern trade. You can pretty much look at this setup week in and week out. Sometimes it's not going to be available, sometimes it will, but you'll at least understand the dynamics of it and you'll know exactly when you should take it, when you shouldn't take it, or why you should take it, or why you shouldn't take it, et cetera, et cetera, et cetera. All right. So the one thing that I like to do is I like to simplify this stuff. Let me see if we are not filled yet. All right, so I like to simplify this stuff, and I like to figure out, okay, what's the most simple way to approach this? Because sometimes you come in from the back end. Some by some weird set of circumstances, you've ended up with um, a 3-5-2-1 trade. Long three, short five, long two, long one trade. Something weird like that. You've just somehow gotten to where you're, in that situation. If you play with PDS Trader, that you will find yourself in that situation if you play with it long enough. So whenever I do that and I find myself in that scenario, I say, okay, let me back away from this and how can I simplify this and what does it look like if I simplify it? Okay, so this is about as simple as you can get with regard to an option insanity trade. A 1-2-1. We can go with a 1. So if you want to break it down, we can break it down a little bit and see how this works. And I'm going to have to click on save. All right, so this is a 1-1 trade where we're long 916. That's Monday, Wednesday. Long 916, short 918. The short strike is 1/2 point above the long strike. Okay, that's the first part of this spread. And this is what it looks like when you break it down. Not all that great, right? It's actually at a small credit, but it's not that great of a trade. The risk is almost $100 on it, and then the probability is about 60% that you'll make something because the market does have to move down for you to lose. And excuse me, the profit potential to the upside is only $50. Right, so that alone is not the best trade. All right, so let's take a look at what the other one is, which is where the long is 3.5 points above the short. Okay, and this is just again a 1-1. Now this trade is obviously different, right? This trade is huge profit potential to the downside. The risk to the upside is very, very small, and you're looking at about, I believe, a $30 risk. If it, yeah, $30 risk max to the upside. The credit here is 320, and with the strike difference being at 350 and a credit of 320, we know that that the max risk to the upside, if it skyrockets, is only $30. Now, right here at 302, which is where the long is, the risk is a little bit more at $46. But still, this if you're bearish, this is better than most bearish trades out there. I mean, try and buy a put that's going to start making money at 301.50 for any kind of small premium, or for that matter, risk of 40, 45 bucks right at 302. You're not going to do it. All right, so this is the trade. This is the engine behind this particular trade. All right, this is the one that produces the profit potential. So the profit potential is pretty high. And so what does this other trade do? This other trade creates the profit potential to the upside and reduces the risk. All right. It also reduces the profit potential to the downside, but you dramatically increase the overall probabilities of the trade. And so I will go ahead and create the 121 and update that. And that's what you get. Okay, so now we've created essentially a risk-free projection trade. It's not risk-free, as you all well know if you've listened to me enough. The risk is at 302, and that risk is very small. All right, it might be $10, it might be $20. Worst case scenario, if you actually let the 302 calls expire worthless, but it's going to be small no matter what if the market stays at 302. Now, if the market moves up, okay, the way that we've created this is that this is a credit of 325. All right, the strike difference, if you look at all of this, the total strike difference comes to 3 points. We have a credit that's greater than 3 points, which means that the profit potential to the upside is now 25 bucks. All right, so if the market really moves higher, we'll make a little bit of money. Okay, it's not a lot, but we'll make a little bit of money. If the market stays the same, and I mean right at 302, we might lose a little bit of money. But if the market starts moving down, we're going to start making some money. 100 bucks if the market moves down to 300.5, maybe close to 125 bucks at 300. Right. So if there's any kind of down movement from the time that this trade is placed on until the end of the trade, which is on Monday, this is going to produce a fairly nice profit considering the amount of risk and the probability of realizing anything, any kind of risk like that. So anytime you can place on this particular spread at a credit of 325 or 320, I think I have a similar spread at like 330 that I got filled on yesterday. Anytime you can do that, you're creating a very, very high probability trade. Now, the thing is about this, in order to create this, you have to have this profit potential to the downside. You're not going to make 300 bucks, right? The credit being 325, you're not going to make $325 on this trade 98% of the time. Okay, every now and again, the market will tank while you're in the trade, and you'll get a pretty nice profit. So that's irrelevant. We have to have that in order to create the high probability within the current zone. Okay, so that's how to create a bearish trade, if you will, with very little risk. And you can take a look at these, and you can create these on a weekly basis and just understand what's going on behind the dynamics. And if you see a market move up, you can take it, and you don't have to wait until the close. When the market begins to move down, you're going to see a profit on this. And when the risk is so small, this is something that you can do multiple times. Or if you have this particular trade on and the market moves down, then you can put on a more bullish trade. where the risk is right here. And I'll address that here in a second. So there's a lot of stuff you can do with this the more you understand it. But to simplify it, just look at one spread and learn that spread. And what is the structure of this? It's a 298. Okay, it's and a 298.50. Those are in the money, and the strike difference between the first long and the short is only a half a point. And then the second long is 4 points above the first long. Okay, again, so that's a pattern. That's a formula, if you will, on what you can do with this particular trade. 4 points between the long strikes, a half point above the first strike is the short, 2-1 or 1-2-1. Okay, write that down. Look at it. Look at the different opportunities that are available with it. You can get these, by the way, um, and move all of these strikes up, and you get different prices. For example, if you move that first long up, or that last long, the 302, if you move it up to 304, guess what? That becomes where your risk is, but you're not going to get this price, right? So where the market is at, that's going to be where you get the best price. And all you have to do is you have to see the market make a move away from that price. Okay. Now once you get to the point where you're looking at this pattern, you can begin to play with it and say, okay, what happens if I do a 2-3-1? Okay, what happens if I do a 2-3-1? Well, this is what happens. Okay, now we've emphasized one aspect or one side of this trade, and the side that we've emphasized is the bullish side. All right, so the 298, 298.50 spread, the 1-1, if you'll recall, lost money to the downside, but it made money to the upside. And so now we've created a scenario where it is literally the projection on this, the worst case scenario at 302 is a $42 gain. And that's based on a 330 credit. Okay, now I have this trade on. It is a little bit different. It's a 2-3, which means you're at 3 shorts, which means, as I always say, the more shorts you have, the greater room there is for error to occur in the projection. And so if this is wrong by $10 at 302, if the short is wrong by $10, the projection of that short, then you're not going to be looking at a $42 profit. You're going to be looking at a $12 profit. So don't be surprised at at sometimes these significant differences. However, on the flip side, as I always say, if you're at the 302 and the risk is always going to be at the long, okay, that's where the risks are. It's where the long strike is where the risks are. And if it's at 302, you should be able to get out of the 302 for like 10 cents right before the close. So you might miss some on the short and gain some a little bit on the long, and it'll all even out. To the upside, the profit potential is literally $70, a little more than $70 to the upside, if the market were to continue moving up. All right, and then to the downside, again, you're not going to make a lot, and the risk is pretty good shot at making 50, 75, maybe $100 in this range. That's the high probability. Again, you're not going to make $300. It's not going to go down here. You can't expect that. That's not the probability. What we're looking at is the overall probability of making something and the risk that it took to get there. Okay, so with this one, if it does move down to 296, then this is something where, again, $76, you're going to have higher volatility. This projection is almost guaranteed to be wrong because volatility increases as SPY moves down. That's just the way it is. I've said it 1,000 times. So hopefully everybody understands that. So the risk on this, if the volatility does move down, is actually probably around break even. worst case scenario. And how can you do that? You can go in here and you can increase. So this is an IV of 12, which is probably pretty accurate for the current level of where SPY is. So um, this should be at 302. It should be fairly accurate. I mean, I wouldn't expect a lot of difference at the 302. Nothing dramatic to where you're going to lose $50 on this thing. But nonetheless, I'm going to increase that to 14. And what that does is that assumes a higher price on my short on Monday. And so as you can see, even going at 14, we're looking at worst case scenario of a $30 profit at 296, or excuse me, sorry, 298. I need to increase the brightness of my screen. So that's a $30 projected profit. If it's wrong, $19 at 302. So still, again, we're looking at a ridiculously low risk trade with the 2-3. Okay. Now, anytime you go more and more with those shorts, so let's do this. A 352. And we have a credit of 655 with that. All right, so now we have even more of a bullish, bearish trade with the max profit potential if it tanks of $655, which it's not going to do as a general rule. However, these levels, and this is with the higher volatility, these levels at the 298 level is $155, and then it's still projected at least a break even at the 302. So what's wrong with this trade? Well, first of all, because of how these trades are structured, the margin is very, very high. So for this trade alone, you're talking about $5,000. Actually, no, that's not true. About $6,000 in margin just to place this trade, because you have to put on that margin hedge. You have to put on 5 of them. And so you've got that issue. And so I'm always looking at, all right, what's the amount of money I'm going to make on this trade versus the amount of margin it takes to place the trade. And sometimes it's going to be two grand, sometimes it'll be 3 grand, maybe a little bit more. So if you compare those with the 1-to-1 and the margin that it takes to make whatever it is the profit projection is on these trades, if the market moves down, you'll make a little bit. If the market moves, or if the market stays the same, and again, I've got the higher IV level in here, you're looking at $16 risk at 302. And so, if the market moves to 298, guess what? I'm still making a little over $100. And again, that's with the higher margin, the higher volatility level. Okay. So that's why I like to try and keep it simple to begin with. I do have a 2-3 on with this as well. I have several of them on actually, and so that gives you an idea. We might go ahead and place that trade depending on, let me see if we're filled on the other one. We are not filled on the other one. So one thing I can do is I can switch that to a 324, and that's perfectly fine to do. So let's see here. Just to try and get filled on this. Oh, it's not, the modify is not working. That will get fixed soon enough. We just pushed, by the way, up. That's why it's not working. We were filled. So I was filled on this, and at a 325 credit. All right, so I was filled on the 1-to-1 at a 325 credit. All right, so the next thing that I'm going to do is I want to show you one other trade, and it's kind of similar in the standpoint that The risk is right where the market is, but it's very, very small. Let me update that so you can see. All right, so we are filled on this trade. The projected IV is actually at 0.12, and that's what it looks like. Okay. All right, so the second trade. Here is the simplest version of this trade. And you see this in the graphs a lot. If you're looking at the different opportunities from the different strategies, especially the inside and the the inside ratio, you'll see this. It's a W trade. It's what I call a W trade. The projection here is that it's not going to lose money, but it has two different places where it could lose money. It's at the 296 area and the 299 area. Okay, the 301, which is where the long strikes are. Okay, so again, this is a pattern trade that I'm showing you, and it's something that you can look at. And if these are the only two trades you look at week in and week out, you'll do just fine. You're not gonna make a killing every week with these types of trades, but it's the risk and the probability of realizing some sort of success is just tremendously in your favor. All right, so I do not place on as a general rule these W based trades. Um, they're not bad. Again, the margin is pretty small at 2, and most of these, by the way, the margin is going to be there's going to be two shorts, at least two shorts, and so that creates a scenario where it's going to be at least 2,400 bucks, sometimes a little more depending on the timing of it, because you have to go a little bit further out to get that margin hedge at a penny or 2 pennies or whatever. All right, so uh, with this one, again, the pattern is 296, 291. There's a 5 strike difference between the longs, and then there is a 3 strike difference between the shorts. And you'll notice that those are the shorts are sandwiched in between the longs. The first short is 1 point above the first long, and the second short is 1 point below the second long. All right, that's the pattern. And you can put these together all day long in various places where the market is, et cetera, et cetera. All right, now again, so this is almost the simplest form. So let's take a look at what the breakdown is on each of these and why it is the case. Okay, so that is the 296, 297, and the probability, again, not the greatest. Anytime you have the short is higher than the long on these, you're looking at more risk to the downside. Okay, but nonetheless, we have 296, 297 spread. The spread is at basically a 49-cent debit. And so the worst case scenario, if the market tanks, is $49, but you have this area where, again, at the long strike, it actually goes to $125, and the max gain to the upside is $50. But you have a high probability of realizing some sort of gain on this trade, because the market to hit the break even has to move down to 299 or below, and so we're close enough to the end of the trade where it's a higher probability. If this trade were placed on Tuesday and expires basically the following Monday, then you have a much lower probability of success with this individual trade. So again, individually, I wouldn't take this trade. So what's the other side of it? We just play around here with it, and this is the 301 300 trade. Okay, so this trade alone is worth taking because you have you only have a one short, right? So that's low margin. B, the risk is very small. It's right at 301. If the volatility is wrong, it's only wrong on one, so your risk at $23 probably pretty accurate. Um, no big surprises are going to happen there. The long again is at 301. That's where your risk is. You might be able to get out of that long at a profit, or not a profit, but for 10 cents. It's not going to be the maximum loss, which would reduce your loss to about $13. Okay, I mentioned this in the very first video that sometimes this trade was available, and it's available now. And you'll make money if the market moves up. You'll make money if the market moves down. All at 298, you're looking at $100. So again, this is a tremendous place to start. And what creates it? You have a scenario where your short strike is lower than your long strike. And that's what creates this scenario. And you still have, obviously, a significant credit on this. Okay. So to the upside, you're only going to make 35 bucks if the market just, skyrockets by Monday. It's probably not going to skyrocket by Monday. But if the market moves down, you lose 23-ish. If the market moves up, you make 14. So the immediate probability. So the 1 point EMR, if you remember the EMR, equal movement ratio, the 1 point equal movement ratio is actually negative on this one. So that's the only major drawback with this is that, if the market moves up a point, great, you'll make a little bit of money. If the market moves down a point, you'll lose a little bit of money. Over the long run, you'll actually lose a little bit of money with all of the ones that have either moved up a point or down a point by the end of this trade. So the sooner you can place this trade on, the higher the probability you give the market a chance to make a move. Okay. Now, that is obviously, again, the engine behind this trade. So what is the purpose of the second trade? Well, again, all of this profit potential to the downside, it's not going to happen. All right. The profit potential here is 135 bucks if the market crashes. If the market moves down to 298, which is again not likely given the time frame that we're looking at, you're going to make 100 bucks ish. And that'll look real good, but it's probably not going to happen. It's probably going to be somewhere between 299.50 and 302.50 is what we're looking at, right? So with that, what we're wanting to do with this other trade is reduce the risk, right? Reduce the risk. And all of a sudden, we have a trade where the profit projection is about $20, worst case scenario, but we're in two positions. So again, that could definitely come down here and be a break even, depending on what you get out of this long and depending on how wrong one or both of these short projections are. Again, this takes now two shorts. So you have $2,000 at least in required margin, maybe 2,500. And but this is a starting point. Again, it's all a starting point, and you start from the simplest, and then you start to work your way up. And so one of the things that I don't take the W trade as a general rule, just simply because I like to be a little bit higher profit potential on some of these, but it's not bad situation at all. So the first thing that you can do is you can say, okay, what if I double up on the main engine of this trade, given the current situation? And so I'll go with a 2 and a 2. Remember, the engine of the trade is the 301 300. That's the engine of the trade. And now that I've gone with a 1 2 1 2, Now I have quite an interesting scenario at a 221 credit. Okay. Um, the max risk here is at $2. That's what it's showing. $2. Again, right at 301, which is where the long strike, the major long strike is. There's a little bit of dip at the second long strike was 296, but it's not much. And the profit potential at 297, 299, excuse me, 299.50 is well above $100. The EMR on this is tremendous if the market goes nowhere. So we're trading above 301.50. This should make a little bit of money if the market stays here, or if it moves up, I can make as much as $121 on this trade. So this is a fantastic trade. The one issue, again, we're now 3 shorts. So if that IV is wrong, if that projection is wrong, come Monday near the close, instead of losing $2, you might lose $20. You might lose $30 if it's wrong by just 10 cents per short. You're looking at a $30 loss. So you can't sit here and say, okay, there's no risk on this trade, and so I want to just I'm going to load up the boat and then realize, oh, whoops, I lost $30, and I wasn't prepared to lose on that trade size. You don't want to do that. So, and maybe that's a fortunate thing about this margin thing is that it doesn't allow you to load up unless you have a much bigger account. Okay, so I like this trade and I like it a lot. I have several of these on, and in fact, I put several of these on, I believe Tuesday, a little bit more risk. The risk was around $40, but that risk was right at 297.50. And so we're right now well into the profit level of that particular trade. And now if the market moves down, I may lose $40 on that first trade, but I'm going to make, somewhere around $175, $200 on the second trade. So again, if all you do is learn a couple of these trades and learn them well, and you'll gain a lot of confidence on when to place them and what to place them at, et cetera, et cetera. They can be tremendous. And again, on Tuesday, I was willing to take a little more risk. It was showing a risk of $40, $50 at 297.50. But again, if the market moved up or down, it was a good trade. And so I was absolutely willing to take that. Okay, now that was pretty impressive based on adding that. What happens if we do a 3-1? Okay, 3-1. 3-1 is super bearish, and if the market moves up, it's really, really solid anyway. So again, the risk here though is $25, but it's on 4 shorts. So if you're looking, if worst case scenario, these shorts are wrong, projections are wrong by 20 cents a piece, highly unlikely, but 20 cents a piece, you're looking at $100 risk there. So again, you have to be cognizant of that possibility. That's an extreme. What we can do here. So the 297. That's really where the risk is, or the volatility is going to increase. That's where the risk of volatility increasing is that 297, but we're only short 1. All right, so if I were to increase the 297 to 14, and all right, so not a lot of difference there. $31 risk. However, if I were to increase, so this one at 300, which is probably pretty accurate, but if it's not, we'll go to 14 again, and that would be highly improbable, but not impossible, depending on the situation. You're looking at a risk of $100. Okay, so that's what you got to deal with anytime you start increasing the shorts. All right, so now let's drop back down. Oops, I forgot to do this one. Drop back down to 2121 with the higher volatility and see what we're looking at. So the 2121 higher volatility, $50, right at 301 again, and that's with very high volatility levels on the 300, which is probably not accurate. This is probably what is more accurate. So a little bit higher. Excuse me, a little bit $4 instead of $2. Right. So this is a 221 credit. If there's ever a time that you don't like the trade, or let's say it's not trading where you want it to trade at, you can just simply put in a higher credit and just let it sit. So if this thing is trading at a 210 credit right now, and I don't want to trade it at 210, I'll just put it at 220 credit and let it sit. If it gets filled, great. And I got news for you: if the market starts drifting down to 301, you will see the spread of this price be a better. So you're not going to pick the absolute best price on these, by the way. And I think that that might be something that some are not expecting, is that you're not going to pick the best price on these. So especially if you get in early on. If you get in early on, you're looking at almost assuredly the ability to get a better price if the market doesn't move. What's the advantage of getting in early and taking a little bit bigger risk? You have a higher probability of the market moving into the higher profit zones. All right, so it's a little bit give and take, but nonetheless, we're going to place on that trade. I'm going to do a 1-2-1-2, and I'm just going to set this up here. All right, so again, this is a structure. 5 strikes difference between the longs, with the second long being at the money-ish, right? There is no 301.50 call, so we'll go with 296 buy and a 301 buy. All right, and then the shorts, we have the short is 1 strike above the first long, and the second short is 1 strike or 1 point below the second long. So those shorts are sandwiched in there. So that would be a 297 sell and a 300 sell, right? So that's trading for about 80. That one-on-one is trading for 82. We're going to go with a 1-2-1-2, and it's trading right at 225. So let's try and get it for 225, shall we? 220. Let's go for 223. See what happens, right? So we'll throw that on there and place the trade. Now again, if the market goes nowhere, I may lose a little bit on both of these trades on Monday. So this is a little bit different because I'm not doing a neutral trade. We could add a neutral trade to this if we wanted, but I'm not going to do that. So let's see here, 223, and we'll just let it sit for a few minutes. Okay. All right. So if hopefully, again, as I'm trying to help you narrow down on, maybe what you can do, because just to become a little bit simpler in how you approach it before you start getting all wild and crazy and trying to put on, 50 trades, and which I don't recommend, obviously, until you have a lot of experience with this. But zero in on 1 or 2 trades, know them, understand them, watch them, play around with them in PDS Trader. Definitely play with the volatility. Go back and look at what the trades finished at. Keep a journal, of these. I cannot tell you how far advanced you will be in being able to take advantage of this approach in a couple of 3 months by doing that. And you'll make some mistakes along the way, no question about it. But the great thing about this, as long as you make sure not to make some huge dumb mistakes, the risks are really small. So usually the mistakes are going to be really small unless you ignore everything I say about having 10 shorts to create $100 profit potential. That's playing with fire. Oh, and that's one of the ratios, by the way, that I look at: how many shorts do I have to produce X amount of profit? How many shorts do I have to have on to produce X amount of profit? And if I have to add a third short to produce $20 in profit, I'm not going to do it. If I have to add a fourth short to produce just $20 in profits, I'm not going to do it because the risk there of that $20 extra gain going bye-bye because the volatility is different than what it's being projected as, is just too high. It's not worth it. It becomes a 50-50 crapshoot at that point. So um, you got to definitely look at that. Now, if all of this wasn't enough, uh, if you still want more, then I've got something coming down the pike for you. Kind of give you a little bit of a heads up in that I'm going to start two different signals. Okay, each of the signals, they're signal services. Each of the signal services are going to take one trade a week. The second one will most likely take two trades a week. And so the first one will be for those who only have about a $5,000 account. And we'll focus on one trade a week, super low risk, high probability of success. You're not going to make necessarily a killing, but you have the potential to do 5, 7, maybe even, 10% a month on these trades, which, which is outstanding considering the risk and considering that most of the time, if the market makes any kind of move, you're going to make some money, right? So there's a signal program that's coming. Again, one for $5,000 account. And if you want to take exactly the trade I take when I'm taking it, they will be presented through Trade Partner. You don't have to have a Trade Partner live account. You can have a Trade Partner free account, and you'll still receive the signals. And then you can just uh, place it in whatever platform that you're trading with, and that's fine. But that's coming down the road. So if you want to follow my trade, a single trade, and it'll be different. There, you'll see some different trades in there, and the timing will be different because every week actually is different on these. You're not going to be able to place this trade at 220, what 223 credit, um, every single week. There are certain dynamics that go into the pricing of options. Like the first week is first week of the month, first Friday of the month is unemployment. That's usually the highest priced options are in the first week of the month. And once the unemployment report comes out on that first Friday, then those begin to tank. And so there's actually some really good opportunities on the following Monday, Wednesday trade from that Friday because you see the volatility drop. And sometimes you see a pretty decent move. And so if you're set up in a situation to see a pretty decent move, you're good. So the timing on each week is a little bit different depending on what news events are going on, et cetera, et cetera. So you don't have to worry about any of that if you take the signal, and you'll certainly be able to learn a little bit more and then not have to do any of the guesswork. You can just kind of sit back and watch and learn as it's being done. The second account or the second subscription service is going to be one where we take a trade and then we look to add to it. And so it's going to require a bigger account. It's probably not going to be 10 grand. You're not going to need 10 grand, but you're probably going to need 7 to 8 grand to be able to take these two trades. And so, for example, I might place on this trade on a Tuesday, and as soon as the market moves, I might place the trade on again with different strike levels on a Thursday or maybe Friday, and go from there. Okay, or it may be two trades at the same time. one that's a neutral trade and one that's more bearish trade or more bullish trade. Uh, so in other words, you're going to be able to take the exact trades that I'm taking. Just like, kind of like right here, anyone here following me, anyone here live could have taken these trades exactly the way that I took. That's one of the reasons I took the first trade at the beginning, to give us time to see if it was going to get filled. And, if you're involved, great. If you're not, that's fine as well. And then, of course, the second trade is kind of the same thing. All right, so those are going to start on October 7th. We had a slight issue with emailing signals this week in Trade Partner. That was resolved yesterday, and so it looks great. So October 7th gives us more than enough time, besides we're going to be gone over the next couple of weeks. And so I'm giving you all a heads up. You can't get on the signals just yet, but I am giving you a heads up. Now, if you're an Option Insanity member, you're gonna get 1 month of these for free if you want. However, in addition to everything else, I'm just gonna throw that in. All right. However, I absolutely, because I'm giving an exact trade, exact strikes, exact price, all at the same time, I absolutely cannot just give this subscription away to members. Um, there are too many. It's absolutely limited. So if you happen, I hesitate to say this, but if you happen to take your free month, the subscription may be closed after that. I just I don't know. It's going to be 100 on each, and I cannot imagine that it's not going to be in huge demand, uh, considering the risk reward ratios of these trades that we're going to be taking. All right, so that will all be discussed in a webinar next Wednesday. And so you'll have the opportunity to decide whether you just want to take your 1 month and learn from that 1 month and risk not being able to get in on a longer term subscription, or if you want to go ahead and get a subscription, then what will happen is I will add your 1 month to the end of that subscription. And we only give 6 month and 1 year subscriptions. This is not going to be for, I just want to take it on a monthly basis. You'll get a month free, and if that's what you want, that's great. So I'm just giving you a heads up and kind of giving you a little bit of a advance notice, so you can be thinking about it, so you can make the decision when I present this webinar, and decide which route you're going to take on this. All right. All right, let me see if we're filled on this. We are not filled on this yet, and it's down to 221. Let me see if I can. So we're going to modify that at 221, which is what the original one was at. So we may be getting, where's the marketplace trading at? Let's see here. So 301.68. If the market moves down to closer to 301, that will probably be filled at some point today at 221, if not fairly quickly. All right, so let me see if I have any questions here. I probably do. All righty. I'm having trouble placing these options in due to the date of the short call being after the longs. Okay, Joe, please. So again, if you're involved in option insanity, you have not watched session 1, you really, really need to watch session 1. And I would strongly suggest you watch session 1, 2, and 3, and a couple of the live trade events in addition to this one before you start taking these trades. All right, so session one, I talk about why you have margin issues, right? And so what you have to do, and what I did with these trades, and what I do with all of them, is I go ahead and I buy an out of the money call, or however many calls I need to buy, that expire on the same short expiration. And so with these, I think I'm long like 310s. September 18th, 310s. All right, so let's go here. Hang on. So I have and let's go with that. All right, so my shorts are on 918. I have to go in here and I have to place on some 310s at 2 cents. And then that will limit my margin. It'll be per short about, if my shorts are at 300, then my margin will be $1,000 per short. If my shorts are at 298, then it'll be $1,200 per short. And so what I do is I just buy those, and knowing that, in anticipation, all right, today I'm going to make these trades. And so I'm going to go ahead and buy those, and I have those in place, and then I just make the trades. You could theoretically place that. So for example, on this one, this is a three-legged trade. You could theoretically add that extra long, the margin long, to as the fourth leg. But what I found is that anytime you add something like that, you're lowering the probability of getting filled at your price, or it takes longer, or whatever the case is. So, like for example, on this trade right here, where it's a 1-2-1-2, if I were to break those up, I could almost guarantee that I would get filled at about 2 or 3 cents better than having the whole trade as a four lot or a four leg. All right, so now that's something that you can look at, but again, you got to have those margin trades on to begin with. All right, so let's see here. And that, again, that is covered in detail. I'm not going to go any more into that because I cover it in detail in session one. All right, let's see. When you create a trade in PDS portfolio, is there a way to copy the trade to trade here without having to Carter, we are working on that. So yes, but not yet. We are working on that. So PDS. So when you like a trade on PDS, just hit trade in trade partner, and so yes, that'll be done at some point. Gary, thank you so much. I actually had that in my notes today to mention. So next Friday is ex-dividend in SPY, third week of every quarter of the end of the quarter. So the ex-dividend is a situation where you do not want to be involved in the markets, even if it's Monday, Wednesday, following the ex-dividend Friday, because they'll assign you, and then you have to deal with that assignment, and it's not fun if you're not watching it. So they can do it anytime, by the way. So actually will not be taking a Monday, Friday trade, or excuse me, Monday, Wednesday trade next Friday until after the market opens. So next week is going to be quiet. You can do a Wednesday, Friday trade. That's fine because you're going to get out on Wednesday, but you cannot do a Friday, Monday trade or a Monday, Wednesday trade for the following week, next week. Okay, thank you so much for reminding me of that, Gary. All right. What is the best day to place the Monday, Wednesday trades? Pete, that's an excellent question. There is no right answer. Because and I don't know when you asked this, so I already may have answered it after you asked it, but as I mentioned, if the earlier you place the trade, the more probability you have of the market making a move into a profit zone. And so I'm willing to take a little bit more risk and get into a trade a little bit earlier. The later you get into the trade, the lower the probability that the market's going to make a move. And so you have to take that into account on whichever trade that you're taking. All right. So if the trade is available, it's available. The only question is, are you willing to take the risk, and what's the probability that the market's going to move into the bigger profit zone? And some of these trades, the profit zone is, I don't know if they're available now, but some of these trades, the profit zone is neutral, right? So how do you create a neutral? I'll just throw this in here real quick. So I will go with a buy at 299, add to new risk graph, and then I will sell. What did I say? Buy at what? Buy at 299, sell at 302. All right, and then let's see if it's available. It might not be. It might be too late. All right, so not the greatest in the world, but this is how you create a neutral trade. Let me create the aspect ratio for that. All right, so what do you have to do with this one? Well, you have it's a debit, so you are risking money to the downside, and B, which is not a problem if you have on one of these trades, right? So that's not a problem. And B, you have to hedge. And again, if you have one of these trades on, you're making money at 305, and so you don't have to worry about that because you're not going to lose money there. So what you're doing is you're trying to increase the probability right here, right? You like how that works? I didn't have to look at any kind of risk graphs to see that. That's the more you look at this stuff, the more you're going to know, okay, I need to create this type of trade. What can I do to do that? All right. Shall we trade this? Why not? Let's trade this. It's 1-2. Why not? That's what I say. Uh, don't take that mentality in. 299, 302, and that's a 1-2, and that's for a debit of 25. Oh, that's a debit of 12. So yeah, it's not as good. The thing about these, the neutral trades, is you kind of run into the same situation. Um, the the closer you get to expiration, these trades go away very, very quickly. So let's see, what is a 3? Now you got to be careful with this. So that's a debit. Yeah, that's not going to work. That's a debit of all right. So I'm not going to take that trade because it's trading at a debit of about 23, and that anytime you get a smaller debit, you're also bringing down the profit potential in the neutral zone as well. Okay, I tell you what I can do. If I lower the strikes a little bit, I will actually get a better price, and I will create a higher profit zone at 301. So we'll take a look at that. Again, I know the structure of these, and so it's just a matter of exposure, and you know how it works, and you can say, okay, instead of a 299, I'm gonna do a 298. and then I'm going to sell at 301. And I'll do a 2-1 ratio. And so that's at an 8-cent credit. And again, to give it a proper aspect ratio. So I'm not going to lose money to the downside with that one. Again, depends on where it is. I will have to have a hedge. And again, if it's a 305 hedge, what's the chances the market's going to go to 305 Monday? Not high, but you're looking at $100. And so I want to definitely make sure, a risk of $100. So I want to definitely make sure that on these, I'm not going to lose money if the market goes to 305. All right. And if I do, if it's a little bit, that's fine. That's a very low probability. So that, the 305 call would cost me 10 cents. And so I'd be looking at basically a debit of 2 cents. And so let's take a look and see how accurate that is, because that's delayed. And obviously the market is moved. All right, so 298 and 301. I know I got off on a rabbit trail, I'm sorry. All right, so that's showing a credit of 4 cents. And 5 cents now. And if the market moves up, that will increase. That credit will increase. As the market moves into this area right here, that credit will increase. And you'll be able to get a better and better and better price if the market begins to move up to a point today. I don't mind taking this trade. The profit potential at 301 is over $100. I don't mind taking this trade, given the fact of what I already have on. So I will go a credit of 0.4. Whoops, 0.4. If I can't get better than that, I'm not going to do it. All right, so I've got that working. You now see the conglomeration of three. Once again, taking 3 trades. May not be filled, but taking 3 trades on the live trade session. All right, let me get back to the questions. Trade will not let me take the first trade you took in my account. Okay, I already covered that. Just going through here, a lot of these I covered during the session. When I buy a 0.01 or 0.02 margin hedge, it radically changes my portfolio risk graph. No. No, it should not change your risk graph at all, actually. What is and where's the risk on the W trade? Where is and what is the risk on the W trade? All right, let's take a look at the W trade. The risk is always at the long strikes, every single time. Always, always, always at the long strikes. Okay. Let me. All right. So here I changed the IV from, it was at 12. I changed it to 14 on the 297 because that's probably more accurate. That's where the risk is. 297. Could it go a little bit lower? Yeah, it could go a little bit lower. I mean, it could go, $10, $12, right at 297. And then the risk again is at 301, which is where the other long is. This is probably pretty accurate, but it could go to break even. It could go $10. And above and below that, you're going to make a little bit of money, but it's not going to be a lot. All right. So, yeah, obviously, let me just throw 14 on that one as well, just to really kind of throw it into a loop. All right, so there with both of them at 14, looking at $10 risk projected. At a half a point above and below, you're looking at $15 gain. So again, really small gains. A full point, you're looking at $35 on both sides. A point and a half lower, and you're looking at $50 on both sides. So really, this is all just unlikely moving into this area, right? So the higher probability is going to be just to change the aspect ratio. This is the higher probability area that you're looking at, right? And you're looking at, at the outer edges, a $50 gain. Not the greatest in the world, but, a given very high probability of success. All right, so that should answer your question. And let me see if we're filled on any of these. So not filled yet. All right, moving down the questions. Can you use puts instead? Gary, absolutely, you can use puts. Matter of fact, I have a put. But what you'll find is that those puts have a little bit harder time seeing the extrinsic value go out of them. So, take a trade with really, really low risk and get to know it with puts, and then you can decide whether it's something you do consistently or not. But they're absolutely, in fact, I took a very similar trade to this one with puts earlier in the week. All right, so that's the 2-1. That's the 2-1-2-1 with the higher volatility. All right, so go to that one and all right, so I took one very similar to this using puts instead of calls. And anything you can do on the call side, you can do on the put side. It's just a matter of how volatility reacts. Let's see. Lots of opportunities for trades like this or other trade. TP this week. Terrence, yeah, we had an email problem, so no trades went out this week. As far as not having anything to do with option insanity, but other issues, other signal services. Let's see here. Just rolling through here. Can you do an option insanity account trade in the IRA account? Yeah, as long as you do the margin, absolutely. We'll return the second signal. Just going through here. John, will there be a discount on the subscription for? Okay, so here's the deal. I'm just going to go ahead and tell you what the deal is. The original option insanity membership is 3 months, and the reason it's 3 months is because I'm giving you a lot of information, obviously some very valuable information, information you're not going to find anywhere else, and information that no one here would have ever just stumbled on, because you would have to know what to look for. And so, in order to make it affordable by most traders, I had to go with a 3-month scenario. You get lifetime access to the course material, obviously. 3 months access to the live trades, 3 months access to the weekly reports, 3 months access to the trade finder. So here's what I'm going to do. There's if you renew your 3-month Option Insanity membership to a year membership, which is $997, very reasonable. So you continue to get all of access to any and all live trade events that I do. You get a year of the trade finders, and I will add. I'm working on adding some as well. So you get a year of that, a year of the weekly reports. $997. You can't pass that up, right? Right. So here's what I'm going to do. This is crazy. Is I'm actually giving you 6 months of one of those subscription services for free. So you sign up for the 1-year membership of Option Insanity, the normal Option Insanity membership stuff, and I'll make sure that you get into one of the subscription services for 6 months for free, added on as a bonus. That's a no-brainer deal. So mostly you're not going to have to worry about whether you do a month free or not, because you're going to want to take advantage of the yearly membership, which is the same price, because for 6 months of the Signal service, it's $997. If somebody has nothing else, that Signal service is $997. So I would absolutely upgrade your Option Insanity membership, because you're going to get one of those subscription services for 6 months. All right, moving on. We'll be able to place the subscription trades prior to the market open, or do we need available during market hours? That's a good question, Carter. So here's the problem with any of my subscription stuff when we're dealing with weekly options. A lot of times, and it is by far the biggest frustration that I have, is that a lot of times I will put in an order, a signal for the next day, and the market opens radically different, which creates a completely different trade than I want to take, and there are going to be different opportunities. So eventually, as many of you know, Trade Partner is going to have the ability to follow a subscription automatically, meaning that, okay, you're going to say, for any smart order that comes in from this subscription service, go ahead and turn on. It'll be something that you decide whether to take all the signals that come across there. And so that way, if I have a trade that I planned to take the evening before, and then the market opens up radically different, and I have to change it, then I'll do that. So and you'll be able to take advantage of that. So so as a general rule, I would like to say that most of them are going to be in the evening, and you'll get them in the evening, but I'm not going to make that an absolute, because if the market opens and it's dramatically different, I may take a different trade. And so one of the other benefits that we're doing is we are creating a scenario where, or creating Trade Partner, where it will also text message you if a smart order file has been sent to your Trade Partner. So it'll give you a text message and an email. And so hopefully we'll create a scenarios that makes it as easy as possible, so that we can be as efficient as possible. And most of the time, when the market in these trades, for example, today, you're going to have, if I send something out at 9 o'clock, it's usually going to be available for a while. So most of these are not going to be, oh, I gotta place this trade now, and you're generally not going to have to worry about that because the market doesn't make radical moves all the time throughout the day. Usually it stabilizes for a while, and so anyway, we're going to try and minimize that as much as possible, but hopefully that answers your question. Um, Harry, the risk graphs on IB are broken. They're if you look at the statistics that they give, the statistical numbers that they give, those are actually accurate. Um, the risk graph, however, it's broken, and I've already submitted a complaint to them about that. Um, so anyway, when will the published cash flow session 3? It is available. If you don't have, yeah, go. It has nothing to do with option insanity, but the cash flow session 3 is up on the site. Any way to keep track of our spreads once they see it in Tradier the day after the position? So Guido, yeah, it's a huge problem. The question is, anyway, so what happens in Tradier, and it, it will cause all sorts of problems, especially if you're in multiple trades like I am, is that it splits the trades up. So you have no clue which legs go with which legs. I mean, so the just right. So here's which legs go with which legs. Can you tell me? And so you have to have some organization. But we are working with Trade Partner to keep track of that for you because Tradier definitely does not. Okay. So I am well aware of this issue. It's not an issue. It's more of a, yeah. How do you keep track of this stuff? Um, let's see here. If you're attending this session, no one should be attending this session unless they are a full member of Option Insanity, which means you have full access to all the Option Insanity um, course sessions. And so you will have lifetime access to those. All right. And just log into PDS Trader, click on Option Insanity, you'll see the sessions listed there, or go to Resources. What is the ideal IV to start with, expecting to increase or the opposite? Every week is different. You just, whatever it's saying, you just have to increase it and stress it that way. Are these trades typically for one unit? They are upscalable by risk tolerance. What is the lowest worthwhile credit to be taken typically? Daryl, that's a great question, and that is completely subjective. It's whatever you're willing to risk. All right. I mean, these have a high probability of success. The only question is, what are you willing to risk? All right. Long-term high probability of success. Um, so if you want me to add fine, okay, so I'll add a 310. So I just added a 310. It doesn't change the risk graph at all. I'm not quite sure. Carter, you'll have to uh, send a screenshot because I have no clue how in the world you're doing that. One thing that you might look at, Carter, is you might look at these stress test levels. If they're not all zero, if you do something like this on accident, which I've done before, then it can really screw the risk graph up. And so just come up here and hit reset to zero, and it'll reset that. Okay. So maybe that's the issue. This is your best webinar yet. I appreciate that, John. Um, Okay, so that's an excellent point, John. You say it seems much more easy to construct these from a formula than it is to search for the risk graphs. Well, do you know where I got these formulas from? I got the formulas from searching the risk graphs, right? So you can search the risk graphs and find one that you really like and then create the formula and see if it's repeatable, and watch it and learn it and understand it. So, tremendous, tremendous, tremendous benefit. The trade finders will help you do that. Play that standard deviation zone on the risk graphs for the front expiration. Yeah. Thing to confirm. You're welcome, Terrence. Gonna return those signals. So trade partner, it can do so much. We should have, quite frankly, we should have already processed version 1 of Trade Partner, but we've added so many different things to it. The smart fills, the texting, which isn't available yet, but it's in there. We're just not using it yet. So the emailing, the sharing, the smart order file sharing, all that stuff didn't need to be in version 1, but we stuck it in version 1. And so, we did have, we pushed a new version out, and it ended up creating some problem with the email last week. That's why we didn't send anything out last week. That's been fixed. Version 1 is probably going to be pushed within the next couple of weeks, and it should be really, really, really solid. Which is why, by the way, it's the last chance to get a lifetime access to Trade Partner. We're offering it right now, and it's the last time that we're going to offer at $9.97 because we're pushing it to version 1. So if you don't have lifetime Trade Partner, get it right now. Let's see. Trade Partner access attempts get a not available message due to maintenance or server issues. Is that resolved? Daryl, I have no clue what you're looking at. Obviously, I'm using Trade Partner, so not sure where you're getting that message error. I'd contact support. Joseph, you get you already get the 6 months for free of the signals. If you already upgraded your 1 year, even though it wasn't listed, I am throwing in the 6 months of signals free. John, I'm going to be dealing with that group. Okay, so can we have take all the signals, or maybe all trade signals, by which system we prefer? Any trades on Aaron, so he's asking, can we choose which ones to take automatically and which ones not? And the answer is yes. So every specific subscription will have the availability to say, yeah, take automatically, or don't take automatically. The default is to not take automatically. So any subscription that you want to turn on and take automatically, you'll have to go in there and take it automatically. It'll throw up a confirmation. Are you sure you want to take these automatically? Then it'll say yes, and then it'll throw up a risk disclaimer. Hey, if you take these automatically, blah blah blah, yak yak yak, and then you'll have to confirm that. So before they are taken, you have to go through several steps to make sure that that's what you want to do. You can't accidentally do it. How do you neutralize it? So I just gave you. So this is. I assume what you mean by neutralize is, how do you deal with the risk? And this is one way to deal with the risk. And by the way, I can tighten these up. All right, fine. We'll do that. I can tighten these up. So instead of, what is this, a 298, I'll go with a 299. Add a new graph, 301, sell. Wherever your short strike is, that's going to be the highest profit potential level, right, by the way. Right, so I can tighten these up a bit and create a credit. Because I'm paying less for the long, but again, at 304, you're going to be looking at risk. So you can do that. Right, so at 304, you're looking at about a $25 risk with this particular trade at a dollar credit. Okay, that's more neutral to neutral bearish. Just throw on the again, it's only 2, so you can throw on a hedge here, and you have neutralized, these other trades here, right? So this one's maybe lose $50 at that level, and this one maybe make $100 at 301. So again, it's just that 1, 2, and a little bit further on the strikes, and that's what you create. Hedge is going to cost you 20 cents if you do that, right? At 304, if you want to, and that's going to add to that risk by 20 cents, and it'll lower the profit potential here by 20 cents. So let's see what that looks like, and you can just kind of see. Oops, I didn't add it to the right one. It goes to SPY. 304 goes to 5. All right, so that's what that looks like. Max risk of $50. Is there anything wrong with this trade? Absolutely not. Nothing wrong with this trade whatsoever. You're going to lose $50 at 304 if you got one of these on. Hopefully at 304 you're going to make that back. All right. But again, what you're doing, you can do too much and create too many shorts. If you have 8 shorts and you have a nice smooth equity curve here at $100, it's not going to be $100 most likely, right? So, all right. Are you learning a lot? Hopefully, in today's call, I think we've made real progress here. Will I get an email regarding the next webinar next week? There will not be a webinar next week. For a session, there will be another session. I have not nailed down. My schedule is getting nuts. I haven't nailed down the day and time, but there will be a session next week. It's not a live session. It's a lesson session. So yeah. All right, excellent. All right, so if y'all can do me a favor and write a comment about what you think about option trading. I never hear from, I shouldn't say that. I rarely hear from people unless they're unhappy about something. So it's good to hear whether I'm getting through, whether it's making sense, whether you're able to take advantage of it at all. Any kind of positive comment would be wonderful. You can either do that via email and shoot it to support, and they'll get it to me, or you can do it here on the comments, and then I'll get them. Yes, a learning curve for sure, especially if this is your first time. Excellent, Kenneth. Great. Great to hear it. All right. So it looks like I've got all the questions. Hopefully, um, let's take one last look to see if we're filled on any of these others. So yeah, I was filled on. Oh no, that was the canceled one. Nope, I wasn't. Haven't been filled on. And the bid ask. Yeah, see that's one of the problems with these. It's showing a mid of 226 and we're at 221. That should get filled. It might be filled if I need to do a reload here on this. Let me see here. Yep. Okay, so I am filled. I got filled at 221. Market's probably coming down. Is why that probably got filled. So filled on 2 trades, not filled on the neutral trade. Should I get, you know what? One last trade for you guys. All right, one last one. I'm going to cancel this neutral trade and I'm going to replace it with a different one, the one that I just showed you. Actually, a little bit different one. As long as it's trading at that credit. Let's see, 299. Oh, we're moving up. Weird. Nope, there we are. 304, 301.49. All right, one last trade for you guys, for all of you who stuck around. So 299, 301. And let's see if we're somewhere in, oops, that's sell, not buy. We are, looks like we are. So this was an 81 credit and I'm showing it at 91 credit. So let's do it. We'll go 0.90 credit just to make sure we get filled on this one. Or hopefully get filled on this one, and we're filled. So now I have a 9, and no, I didn't place this hedge. Should I place the hedge? Should I want to place the hedge? So I'm in all these other trades, and I don't need the hedge. And that's one way that you can do it, but so let me see what that's trading for anyway. I'm going to collapse these charts. So the hedge, the 304 hedge is trading for 9 cents. All right, so I'll place the hedge on for 9 cents. That's a great trade right there. I'll just let it sit. If it's not filled immediately, I'll just let it sit. I'm fine with that. Now, one caution. So I'm filled at 91 on here. So let's just 96. Oops, 97. So I'm filled at 91. This is what it looks like. Probably not going to make 88 bucks right at 301. Let's 13. Let's stress it just a bit. So probably closer to 50 bucks with this particular spread that I put on. Again, almost no risk to the downside basically, and I've got plenty of others that are making money to the downside. So, all right, there we have it. In 3 trades, we'll see how it goes. I will end this for now and see you next week in the regular session. Appreciate everybody attending. Have a great day.